Hello, and welcome to this session of Saving for Your Future Self. The fourth quarter in this session, we are exploring your retirement savings plan in this session. Welcome. My name is Cheryl Hatcher. I'm a benefit educator here at Wespath, and with me is Frank O'Brien, senior benefit educator here at Wespath.
Hello, everyone. It's my pleasure
Hello.
to be with all of you and Cheryl today.
Yes, and we also have a special guest. His name is David Schulten. He is the Senior Financial Planner at EY Financial Planning Services. So, David, say hi.
Hello, everybody.
Hey.
So nice to be here today. Thanks so much for having me.
Of course.
Very well.
David is here. He's going to be having a special little breakout session talking all about the EY financial planning and what they can do to help you. So just giving more emphasis on what they can do. So we're happy to have him with us and to be able to talk about all of that with you. All right, we've got some housekeeping details first. So I want to let you know that if you have any questions whatsoever, please feel free to put them in the Q&A section of the Zoom webinar here. So make sure you utilize that. And with all those questions, we actually have a couple other of our benefit educators. We have our manager, Bob Christoffel. He's there manning those questions for you as well. And Todd Kreviston, a benefit educator here at Wespath. Again, both of them will be answering those questions. So again, submit those questions so they can be answered during this session. One other thing to mention is that this session is being recorded. So when we send a follow-up email, it will have this recording link to it. It will also have a PDF of this deck. Yes, a PDF of this deck. So all the slides that we're going through today will actually be in that as well. We will have a link for the benefit education consultation. So if you want to talk to myself, Frank, Todd, or Bob, we're here to help you with that. And that will be in that email. Also, the EY information regarding their website and the phone number to contact them will be in that email. One other thing I want to mention is that there will be an attachment to that email. And it's an attachment that's coming from EY, but it will be part of this email from Wespath. It's called Know Your Numbers. And David will be actually going through that information during his breakout session. Okay, so have I answered all those housekeeping sessions, Frank?
I think we are good to go.
All right, we are good to go.
Onward.
We got the okay from Frank, so that means we're good. So now we're going to go on to what's the agenda for today. So the agenda is, what is that United Methodist Personal Investment Plan, or UMPIP, or UMPIP? We're going to talk through those contribution options and those investment options that are available to you. We'll also talk through the accessing your account, investing with Wespath, all those different ways that you can do that, all the resources that are available to you. There's many of them. We'll go through all of those, and of course, we'll be talking about the EY Financial Planning Services. A lot of stuff to cover, so let's get to it. The United Methodist Personal Investment Plan, or UMPIP, it is a defined contribution plan. And that plan actually accepts contributions from your plan sponsors or your employers, and it also is accepting of your contributions via payroll deduction. Again, you've got many different choices with this. You decide how much to contribute. Do you want that to be on a dollar amount or a percentage based? We do recommend that percentage because as your salary goes up, then your contributions into your UMPIP account increase as well. How to contribute? Do you want it to be on a risk basis of being moderate or conservative or even aggressive? And how is your money invested? Which kind of funds do you want to be in? Do you want life stage investment management to do that for you, or do you want to self-manage it yourself? A lot of different advantages of participating with UMPIP. So if you're not already in it, here's some good things to think about to be in it. You can actually save on taxes. The taxes are actually deferred on a before tax. If you submit your contributions on a before tax basis, that means that you're saving money now, but when you take that distribution out in retirement, you will be taxed on that. Or you can actually put money in on a Roth basis, which means that the money that you're putting into your UMPIP account would be on an after-tax basis, so that once you take a distribution from your account, those, if you have the qualifications met, then your contributions and your earnings would be tax-free. Another advantage of participating in UMPIP is the autopilot solution. We've got life investment management for your accounts, and then we also have life stage retirement income for your distributions. Okay, we will talk a little bit more about life stage as the webinar goes on. Another advantage is sustainable investments. Sustainable investments means that your money is diversified in diverse long-term sustainable investment funds. So more of the money stays in the fund where it should, and we do abide by the principles of the United Methodist Church. And then lastly, another advantage of UMPIP is that you have EY financial planning services that is available to you at no cost. We say no cost. They are a for-profit company, but their invoices are paid for through our operating expenses through the funds. But for you, the person who is going to be calling EY or contacting them is going to actually be at no cost to you. Now, David, when you have someone contact you, is there what kind of advantages are you seeing, or are you telling them to be into UMPIP?
Yeah, so you've already highlighted a good chunk of them for the investor, for anyone who's contributing to the plan. So it's a very unique opportunity because there's not a lot of vehicles out there where you have the ability to defer your income into a plan. And so we really are big fans of that, especially with the ability, Cheryl, as you had mentioned, where participants can choose to contribute on a percentage basis. There's also a auto escalation feature. So if you start off with a 1% contribution, for example, you can automatically increase that contribution, say by 1% per year. So that way, as time goes on, you can see your contributions increase very gradually. So we really love that about this feature. And then as well as the opportunity to have a really nice, well-balanced, diversified portfolio. That is a core principle. Asset allocation represents some studies by Ibbotson. One of the fellows who's a Yale professor said that about 90% of the returns are actually attributable to asset allocation. And so combine that with active managed low cost funds. This is a fantastic opportunity for participants to help build their retirement.
Wonderful. Thank you so much, David. So appreciate that insight.
Absolutely.
Yes. Now we're going to turn it back over to Frank, who's going to continue on.
Thank you, Cheryl. So now we're going to spend some time talking about the contribution types that are available to you in UMPIP. I'll go through the contribution types. I'll hit on the 2025 contribution limits, and then bring back David in a little bit, and then we'll talk about some retirement concepts and continue that conversation before we move on to investment funds available in the plan. So the most common types of contributions available to you are the Roth and the before tax contribution type. And on our slide on a regular basis, you can see, always have a conversation with EY to talk about which one works best for you. So the before tax contribution, the words are kind of telling us what's going on here. You have your base pay, and then your contribution amount, be it a dollar amount or that percentage amount, comes out, goes into the UMPIP plan, and then the rest gets taxed. Now there's a difference between lay employees and clergy employees, and we'll get to that on a future slide. But you have your contribution reduced, and the taxes come through, and the net amount goes to your paycheck. The contribution has not been taxed yet, it's tax deferred. The earnings on that account is tax deferred, and so in retirement, or if you take a in-service distribution or a hardship distribution, that will be taxable as ordinary income to you, that entirety. The Roth contribution is an interesting contribution in that it's an after-tax contribution, but it kind of gets structured like a before-tax contribution. You have your base amount of pay, and then we calculate that dollar amount or percentage of contribution you want to go into the Roth account, but we hold it. And from that base amount of pay, we start to apply the taxes. And then after that is done, that calculated dollar amount goes into the Roth account in UMPIP, and then you get your net check amount. The way that works is the contribution itself has already been taxed, so it won't get taxed again. But if you qualify the Roth account, and to qualify it, it's pretty straightforward, then your distributions in retirement will come out tax-free. Because of that structure, we're holding the amount, but everything's getting taxed. We're in effect front-loading into the Treasury the taxes on that payroll period, so you get the benefit of the earnings in the retirement plan. For that account to be qualified, two things have to happen. First, you have to be over age 59 and a half, which is a magic number in the retirement world. We're going to get back to that later. And then secondly, the very first Roth contribution has to age up 5 years. So you get that one contribution in there, you're 5 or more years later, you're over age 59 and a half, then those distributions can come to you tax-free in retirement. Now you'll see on this slide if there's a long-term disabling condition or a person passes away, then that treatment applies to that as well. So you have those two primary types. Also within the UMPIP is where we have our rollover account. You can roll over prior employer-provided retirement accounts or a traditional IRA that you may own into the UMPIP. So it would be another 401k, 403b, similar to UMPIP, a governmental 457 plan, and again, your traditional IRAs, you can roll into and consolidate your retirement accounts into UMPIP. We recommend doing that. Have that conversation with David and his team about doing that, because we think it gets 10 to 2 better when all your retirement accounts are together, as opposed to you having to look after this old employer or that old employer or that IRA. And then you're going to hear about the different programs that we have available to you to really optimize how you can get your income in retirement. It's a very simple process. We have an incoming rollover form. Cheryl, who is sitting with me today, is the rollover queen. She will take care of that. It is a direct rollover. You don't touch the money. You don't see the money. It all happens behind the scenes. And because we structure it that way, it is a non-taxable event to you. So we'll get you that form, or you can get that form through Benefit Access, fill it out, bring it in, and Cheryl will take care of it from that point on. Those are the three primary contribution types. Before we leave this segment, I'll talk about another, and it's related to the contribution limits. The UMPIP is a defined contribution plan. The IRS, through law and regulation, defines for us how much contribution are we permitted to contribute in a given year. So here are the 2025 limits, and we have a new twist to how these limits have been articulated. So under age 50, that's the baseline amount you can contribute, and this is before tax and Roth combined. Okay, it's not each, it's kind of combined however you're using these accounts. This 2025's limit is $23,500. Now, if you're over age 50, that catch-up contribution comes through, and that's actually remaining at $7,500 for a total amount of $31,000. However, what's new this year is for participants who are age 60 through 63, there's an additional super catch-up that you can do to increase the amount over the course of those years going into your account, and that amount is $11,250. So the overall amount for that is $34,750. Then you become age 64 or older, and it reverts back to the regular catch-up and the $31,000 for 2025. So these are the numbers that are available for 2025. But we here at Wespath understand that these are robust numbers. However, if you as a household have the opportunity to meet these levels of contributions and exceed these levels of contributions going into a retirement plan to provide income to you later on in retirement, then the after-tax, the pure after-tax contribution account is available to you. With this account, again, you get your monthly gross pay. Taxes come through, the contribution goes into the account. Contribution will not get taxed again, but here, any earnings on that account will get taxed. So it's different than a Roth contribution. So again, another time to have a conversation with an EY financial planner. Before I get into certain concepts that also apply, I'm going to bring back David and ask him, as he's having conversations with our participants and the contribution types that are available. So it's kind of twofold. Are we still seeing primarily before tax contributions, or is that Roth account starting to get a little bit more action from your perspective? And then also, how does the rollover kind of work into the conversations that you're having with our participants?
Yeah, that's a great question. Yeah, I would say predominantly I see pre-tax or before tax contributions primarily, but yeah, we are starting to see a little bit of a creep up in the Roth area. It hasn't been around as long. I mean, I think the Roth IRA came out in the mid 90s or so, and then it took a little bit more time for qualified plans to adopt those Roth provisions. So we're really only looking at maybe 15, maybe 20 years tops, um, maybe even less than that in terms of the ability to make the Roth contributions. It's an extremely, I would say, case by case basis, depending on uh, what the goals are for the individual. Um, Looking at, of course, I think, and here's a little plug here. We do have a calculator on our EY Navigate website to help participants understand, is it more optimal perhaps for me to make a contribution on a Roth basis? Do I still consider, or if I am already doing pre-tax contributions, do I continue that path? Um, and there's not always an extremely, I would say, easy answer, because we do have to make sure that we take into consideration the tax savings that we do get today from the pre-tax contribution. So there is a little bit of a measurement involved, but rest assured we do have planners that are going to be able to walk you through those calculations and help explain that.
And what I have come across a couple of times, not frequently, but a couple of times, is clergy who really understand the housing allowance tax exclusion, but also know that they've been in ministry for a long time, that their housing allowance is going to be covered. For the last 5 to 10 years of ministry, they're moving into the Roth so they can get the housing allowance tax exclusion, but also receive that tax-free distribution from the Roth account. So really thinking about it, and it kind of brings up the next concept, in terms of tax efficiency strategies. Now, this actually is an EY slide that we were able to use, and I will grant you this is a busy slide. But what this is articulating is the difference between the before tax and the Roth, and also between clergy and lay employees. I'll start there. Lay employees like myself and Cheryl, if you're doing a before tax contribution, your gross pay comes in and then FICA gets applied, and then it's the before tax contribution and the remaining taxes occur. Whereas with clergy, you have that gross amount of pay, then the contribution is calculated, and then from there, SICA and the remaining taxes occur. But the thing to point out also on this is the take-home pay. So for those who are doing before tax from the base amount there, you can see that there is more take-home pay on a before tax basis than there is using the Roth. There's less take-home pay, but again, you have that future benefit of tax-free distributions. So David, to kind of hit this topic a little bit, and you kind of mentioned it too in terms of the modeling that you'll do, do you often get kind of granular into any of these tax efficiency strategies with our participants, or is it just more kind of keeping it at a higher level, and obviously the numbers here kind of tell the story?
Yeah, absolutely. It depends on the scenario. We could get a little bit more granular. As you had mentioned, Frank, oftentimes what some participants, just across the board, not necessarily specifically at Wespath, is they may not necessarily realize that if they go with a Roth contribution, that their take-home pay might be a little bit less. So the cash flow piece is an element of that. But when we're also running their plan, so when we're running a plan for retirement, and not just leading up to retirement, but some people may have 20, 25, 30, maybe 35 years throughout retirement. Could there be some optimization by making some Roth contributions, especially if participants, let's say, for example, you're a clergy person, your surviving spouse, if they are not clergy, will no longer have that housing allowance. So could there be some optimization for longer term asset building purposes to have some tax-free dollars in that plan? So there's a lot of components to that. So we do, to your point, can get very granular if need be, but we'll typically start off a little bit more high level just so that we don't get too deep into the weeds right off the bat, but we certainly can get more granular on a specific participant by participant basis.
Yeah, and we most definitely appreciate that, because although we will hit on these concepts as the conversation gets a little deeper, we're saying, well, call EY Financial Planning Services. They can go a little deeper into that conversation. A couple of slides on continuing to talk about some retirement savings concepts. And again, then we'll bring David back in for his perspective on this. First is dollar cost averaging. Dollar cost averaging is a kind of a fundamental principle in retirement savings. Our retirement savings, just to kind of illustrated, comes out of our payroll. So we get a gross amount, then we have contributions that are going into the plan. And that's on a regular basis, be it the 15th and the 30th, or once a month, or what have you. So dollar cost averaging, you're buying a different number of underlying investment fund shares throughout the course of time. And this is kind of a counterfactual to having maybe an inheritance or a lump sum of money that you put into a fund one time. Now that, history tells us that one-time deposit will make money. It'll have earnings over time, and that's all fair and good. But with dollar cost averaging, you actually get a higher internal rate of return because of the dynamic that occurs with the frequency of the contributions being made. So here we have an illustration. You can see on the gold the number of shares that are purchased, and then you can see with the blue what the share price is. So over time, markets change. They go up and down. So you can look at April, the markets are doing fine, it's got a nice share price. You're only buying, in our example here, 16 units of the underlying fund. And that's all fair and good. That's a part of the retirement savings that you're doing. But during the course of the year, there's a little market gyrations going on. The market sells off a bit. Now that share price goes down, now you're actually buying more shares into the fund at that time. So you can see in our example, 28. And that dynamic over time kind of continues to fill the bucket of your underlying shares while the market price activity is doing what it is doing over time. And again, you end up with a better internal rate of return as a result of that. That's what history tells us. And then the other one is just the time value of money. You're putting your contributions in. We have an example here of somebody who's starting out at age 25 as a $35,000 compensation. We're going to have the compensation go up 3% a year. Annual investment gains of 7%. They're contributing $500 on a per payroll period. And you can see that that money comes in. And it goes up. The first instance there from 25, contributing 1%, lost my train of thought, contributing 1% there, that's going to go up that 102,484. But if that individual can contribute 4% starting out at the beginning, you can see the range in return that you're going to get by contributing more earlier than contributing less. But we understand that life circumstances are our life circumstances. So we also have an individual who's getting started later on at age 45. They've had other things to do, buy a house, get kids through college, et cetera, but now they're able to contribute 6%, doing a little bit of that catch up on the years not contributing at all, and you can see that the amount goes up here as well over time. The story of this slide is that time value of money. It is not, oh, I've gotten too late in the savings for my retirement, I'm not going to be making up that much. That is not what this slide is about. This slide is about getting in as soon as you can, to the extent that you can. You will see earnings over time and have that available to you for retirement income. So I'm going to bring back David with this again, just to kind of hit on some of these concepts. And certainly, David, feel free to clarify anything that I may have said that was a little bit off with the understanding of dollar cost averaging and time value of money.
No, absolutely. That was perfect. I think that ultimately, as we can see, the sooner that we start, the better we are. The longer that money has the ability to compound and continue to compound over longer term periods of time. But at the same time, it's, if all of a sudden we realize, well, maybe I waited a little bit, it doesn't mean that it's too late. So we want to make sure that we get in there as soon as possible. And I think one of my favorite parts of that previous slide, Frank, was that a lot of people think if the market goes down, oh boy, that might be a time for me to make some changes to my portfolio. Maybe I want to get a little bit more conservative. Not necessarily going into that level of detail here right now, but because of the ability to buy those shares at lower prices, the dollar cost averaging, to your point, helps to optimize those returns because it can smoothen out our purchase points throughout the course of time. So if we can get it going sooner rather than later and really take advantage of that time, but also to be able to take advantage of being able to contribute on a monthly basis, it helps to smooth out our entry points throughout the course of time.
Thank you.
All
And now we'll go
right.
back to Cheryl to walk us through some investment options.
All right. So thank you again, David, for all that insight that you gave. So let's go talk about the investing your account. So the benefits of investing with Wespath is, again, I had mentioned during the advantages, is that we do practice sustainable investing. So again, we do practice and have that sustainable investing according to the benefits in the of the United Methodist Church. So we do look at that. The socially responsible investments, so the ones that we are looking at and investing in are ones that do uphold the values of the United Methodist Church. We do look at diversified options, so not where we don't want all the eggs in one basket, or we want things to be diversified. So you do want some different types of investments in your portfolio. You can actually see the competitive returns according to the benchmark that we look at other companies that are out there, and we see how we are doing in relation to them. Again, we've got low expense ratios and no commissions, so more the fund that you have stays in the fund, so it's not being paid out. And later on, I will be discussing life stage investment management to give you some more information on that and what that all means. Here is a wonderful slide that actually shows the fund lineup, which is the risk versus potential return scale. So on the lower bottom with the stable value fund, this is the the capital preservation funds for the category. It's your short-term income fund. This is going to be a fund that you have for safety with some income in it as well. Go up the next level to the fixed income funds. These are different bond funds that are available. And these bond funds do give income at a little bit higher rate than you would have for the short-term income funds. And they do go up in risk as you continue up on that scale. I'll then go to the top with the equity funds. So we do have in there the new one that we have, the U.S. Equity Index Fund. That's one of our newer equity funds. But all of those, the equity funds are for the growth. So as you can see, they are in the top of this chart. They do have the most risk, but they also have the most potential for return. Now I'm going to go back to that balance fund. That's what we call our multiple asset fund. That is actually going to be a mix of our equity as well as our fixed income funds. So the balance fund is what we call our growth and income funds, and it's just a mixture of the ones that we've already listed there. So it's a wonderful chart showing all the different funds that we have and their risk versus potential return. Now, as far as the participant investment options, our core paths, you have many ways that you can actually invest in your funds. Life stage investment management is one of the ways that you can do that, and I'll talk about that in the next couple of slides. Or you can actually self-manage, where you actually pick the funds that you want to be in. Choose those, the mix that you feel is best for you. We always have EY Financial Planning Services that you can either, you can contact them for either participant investment option that you pick, whether life stage or self-managing. EY is there to help you with any way that they can. So let's talk a little bit more about life stage. So life stage actually just creates that diverse investment portfolio, and it's customized for each person, each participant. So yours are going to be different from mine, it'd be different from Frank's, different from David's, because again, it's diverse, it's customized just for you. So it does set that asset allocation based on particular variables for you, and this allocation is reviewed quarterly based on your birth date. Whatever that allocation is, it may need to be rebalanced, and that's what could be done on each quarter on your birth date. it could rebalance that to get it back into the mix that we deem you to be needing to be at. And this service is available during active service as well as in retirement. So a little more information regarding this life stage. It is a management tool for all of your defined contribution accounts. And again, it sets your accounts on autopilot. Now, when I talked about the advantages earlier, it doesn't mean that we are just being idle and not doing anything about it. Autopilot means that you are not having to worry about it. LifeStage actually does it for you. It actually picks those funds and sets that allocation for you. And those fund allocations are tailored to each individual because of these different variables that we have, such as your age, your risk tolerance, if you're eligible for Social Security. So all of these different funds make a difference in making each retirement tool individual just for you. Now, if you are not, if you don't have a personal investment profile set up in our benefits access system, then one will be given to you, i.e. it's going to be in a default. The default is what we deem as being moderate risk tolerance, benefit commencement age of 65, and that you're eligible for Social Security. Now, if you can also go to our customer solutions team to have them help fill out that form for you. Otherwise, this is another conversation you can have with EY. So David, is this, do you get many questions regarding what type of investment profile I should be in, and maybe what different types of risk tolerances you should have?
Often, and so I would say, thankfully, most of the time, whether someone decides to go more conservative, moderate, or aggressive, what we can always do is to go through an exercise with your EY planner to just ultimately confirm: am I actually moderate? Do I want to be more aggressive, for example? So we do have a few exercises that we go through to help understand that. But the good thing is that most, in my experience at least, and I don't want to necessarily say that this is the case for everybody and all of our planners at EY, but the good thing is that oftentimes it is confirmed through a second screener that the allocations that are in your life stage investment management are appropriate and well diversified across all the various asset classes. We want to make sure that no matter what risks are available, are present in the marketplace, whether growth is increasing or growth is slowing, or inflation is increasing or inflation is slowing, we have these various asset classes in our models at Wespath to be able to manage these various risks. And so it's just more so saying, okay, given where I am in either today, but compared to how long I have until retirement, or if I'm in retirement, is this still an appropriate allocation for me? And so we can help to confirm that for participants.
That's wonderful, David. So also, is this something that all of your different modeling and your different calculators that you have on your website able to help with those types of situations?
Yes, absolutely. And there's when we go through the exercise, it provides a nice visual so that people can understand what their expected returns are. So that way, when we're running our retirement plans, we can use an expected return, but also outlining what potential loss scenarios could be for someone to make sure that they are comfortable in that particular model. Absolutely.
Wonderful.
And what I, if I may, and what I really like about the program, the way I kind of frame it is, there's two time horizons that we're working with simultaneously. So that autopilot feature that Cheryl talked about, we're setting somebody up, but over time it's a glide path. So we don't set it up and then just kind of wait a few years before we start saying, oh, somebody's this age now, somebody's that age now, getting closer to retirement. We're in a constant way of looking at it to get that glide path to, into, and through retirement. But as Cheryl mentioned also, that rebalancing. So during the course of the year, we're actively managing the portfolio to have it where we want it to be, regardless of what the markets are doing, to keep you where we think you should be at that point in time. And we are permitted to say that because of that, there is a potential for a higher internal rate of return, because we're actively managing it in the real term while we're also doing that long-term glide path. So I think those two pieces, as I frame it, David, working together is very powerful within the program. life stage investment management.
Oh, absolutely, 100%. And there's a lot of data and studies out there that also suggest that the continuing of the rebalancing throughout the retirement phase, through the distribution phase, is also going to help to extend the longevity of the portfolio. Because if you think about it this way, when we're driving down the road and if we're like kind of taking our eyes off the road a little bit, we might start to veer into the other lane. And so that quarterly rebalancing helps us to stay right on our target, no matter what the market conditions are.
Perfect.
Very
Great
good.
way,
Thank
great
you.
way to explain that. Yes. All right. Well, thank you, David, for that. As far as the investment information that's available at Wespath, plethora of it. So you can see all sorts of information regarding the daily values, fund descriptions that we've mentioned. Seeing those benchmarks and fees. Lots of information out at wespath.org. You can actually go there to actually get to benefits access, which we'll be talking about as well. So a lot of great information that's out there and available for you. You can spend many hours out there, but a lot of great information for you to review. All right, so now we're going to kick it back to Frank, who's going to talk about accessing
Your account. Thank you very much, Cheryl.
You're welcome.
So we have spoken about contributing into your account. The account is going into the Wespath family of funds, either through self-management or through life stage investment management. But over time, you're going to want to be starting to access those accounts. Now, there are different times that you may access your account. Certainly, our primary focus is on the retirement side to generate retirement income. But you're going to hear about the ways in which you can access your account while still in service. And, we always call out that by accessing your account while still in service, or maybe taking a huge amount when you go into retirement, can impact your financial security over time. So here in that blue box again, speak with EY, your own financial planner, your tax preparer. Make sure you're utilizing all of those resources before you actually do come in and start accessing your retirement accounts, because we want everybody to have a fruitful retirement. Now, accessing prior to retirement, you can see there are a series here. The ones towards the bottom are qualifying events. If you think you may qualify for a distribution while in service, call our customer solutions area. Speak to them about that, military experience, disability, what have you, and they can work with you to understand eligibility for a distribution. But right there in the middle, we have in-service withdrawals at age 59 and a half. I'm going to start there because I talked about 59 and a half being a magic number in the retirement world. If you're over age 59 and a half, and folks, we're talking about accessing your personal investment plan account, not the employer monies, your PIP account. If you're over age 59 and a half, you can go in and take an in-service distribution from your account if you need be to take care of something in a life happens situation. It's going to be considered ordinary income and it will be taxable, but since you're over age 59 and a half, there isn't a tax penalty. However, if you take a rollover withdrawal or one of these hardship withdrawals we're going to go into, if you're under age 59 and a half, not only is it subject to ordinary income taxes, there is a 10% tax penalty that applies to that distribution as well. So rollover, if you can take that, know your age and what the tax consequences are going to be. If you're over age 59 and a half, hopefully you don't have to touch it, but if you do, you do. But again, life happens. So we have hardship withdrawals. Hardship withdrawals is your ability to access your personal investment plan, but there's only 12 or 13 qualifying reasons for you to be able to access your account under age 59 and a half. So purchasing a primary residence or preventing foreclosure, funeral expenses, medical expenses, higher education expenses, things like that. Again, call our customer solutions area. They will work with you to understand your qualification. The amount of withdrawal that you can take is the amount that you need to satisfy that hardship. So we're working with you to understand how much to withdraw, but we also understand it's going to be taxable, so that we'll figure out the amount to add on top of that needed amount, give you that kind of trued up amount. So you'll get the distribution, there'll be taxes withheld, but the resulting net amount will be what you need to satisfy that hardship withdrawal. Now, it may be that you need to access your retirement account for something in your life, but you don't have to take a withdrawal. Your overall cash flow, your overall situation allows you to take a planned loan or a hardship loan. In the UMPIP, there is a loan feature. You're using your accounts, you're loaning it to yourself at a rate of interest, 2% above the prime rate, at a rate of interest. We do the rate of interest because you've taken the amount out of the account. It's not getting earnings anymore from the investment funds. So by having an interest rate applied, you're kind of getting some of that lost interest back into the account as you make your loan repayments. There are two types of loans that we have. The first is simply a primary residence loan. It is for the purchase of a primary residence. You can extend this loan or amortize this loan up to 15 years. Doesn't have to be the whole 15 years, but for the purchase of a primary residence, you can take it out for 15 years. Any other reason, it's for 5 years. Again, you don't have to take it out for the 5 years, but for any other reason, you can take out a loan, pay it back to yourself, and you have 5 years to do that. In retirement, there are several distribution options that are available to you. For clergy, we recommend the account balances going to UMPIP by rollover. Those of us who are in UMPIP, just because of the virtue of our participation here at Wespath, we have these distribution options available to us. You can always take out a full lump sum. You can take out a partial lump sum. And by doing that, you certainly want to talk to someone like an EY financial planner, because you're taking that money out, and it could be for very good reasons, don't get me wrong. But you're taking that money out, it's not available for distributions in retirement now. And also, for those who are clergy, you also want to understand what the impact to your future housing allowance tax exclusion can be. So we often have these conversations, certainly partial purchase of a residence, those types of things. But you want to understand like the immediate need, but also the longer term thinking around that. And also the year in which you take that distribution, you can end up in a higher tax bracket. So these are things, just considerations that you want to have if you're going to do that. Those in retirement, you're looking for a steady stream of monthly income. You have two options. Life stage retirement income, a program we have at Wespath where we're determining and calculating the amount of monthly installment payments to provide to you through retirement, with the intention and the practice of giving you increases in that amount through retirement to help keep pace with purchasing power. But just like investing, you can self-manage the installment program that you want to put yourself on. You call our retirement team, you say, I need $1,100 a month, and then when that changes to either $1,200 or maybe $900, you just call us up and we'll make that change for you. The IRS allows you to defer taking distributions from your retirement account up to a particular age. If you attain that age and you have to start taking required minimum distributions, we will work with you if we see an account that you have not triggered benefits on yet, and you could be exposed to RMDs. And I'm sure David will say that there are plans that are in place that it's intentional for that deferral and RMD to occur because it is a part of an estate plan. So that could be also what we hear. And then again, that death remaining balances go to your beneficiaries. So before I bring David back in to kind of see like situational thinking that he's come across some of our participants and issues and stuff that has come up, hardship loans, life happens. 3 weeks ago I found out I needed a new air conditioning unit. 2 weeks ago I took out a hardship loan. I sat down with my wife, we looked at it and said, well, we have an emergency fund, but it's going to be this much. How much do we want to take from the emergency fund? We could do financing through the air conditioning company and whoever they use to finance, but now we're paying them that. So what we decided to do was kind of do some for the emergency fund, and then I took out a plan loan. Life happens. Now I'm paying that back to myself over 5 years. It'll be there available to me, please God, in retirement. So we understand accessing your accounts can occur. Certainly we focus on retirement. And David, anything come to mind as I was kind of going through those various scenarios? Certainly the pre-retirement things happen, or also the thinking through how to access and the amount to access when you start to hit your retirement years.
Yeah, absolutely. And I want to give a quick plug to, you can, on the benefits access site, you can apply, where it says apply for a loan, you can model a loan scenario, which we'll oftentimes do because we want to make sure that first and foremost, as you had mentioned, Frank, life happens. So it's good to know that we have access to potentially up to $50,000 for a loan, or 50% of the balance, whichever is higher, and again, that ability to pay it off over 5 years. But how does that impact our cash flow? Do we need to revisit our budget to make sure that we can make those payments? Because if we can't make those payments, then the IRS is going to treat that as a deemed distribution. The other piece that I really wanted to make sure I mention as well is I'm not familiar with any other plans that allow for loans for anyone who's retired, which I think is a amazing option. Most plans that we work with will say, hey, once you're separated from service, no more loans. So it's a fantastic opportunity to be able to access capital if needed more than perhaps what you're taking out on a monthly basis to cover some perhaps unexpected expenses, or maybe I'm building a home, for example. I want to have some monies for a down payment. You have those abilities to access those loans even after separation. So, but yeah, we do want to make sure that we take a look at the payments and also looking at the ability to get those monies back into the plan over time. So it tends to be a good option for most, maybe not for everybody. So we'll want to look at other opportunities as well. As you mentioned, Frank, maybe it's balancing out a little bit with some of the emergency fund. Does that make sense? So yes, we have those conversations quite often.
Yes, I'm sure you do. So now we're going to actually have this, you're getting a feel for the different types of questions and situations that David and EY comes across. Now we're going to kind of hone in a little bit and give a bit of a primer as to how they approach the financial planning model through EY. So I'm going to do my best to keep pace with David, but we're going to get into participant resources and EY. So David?
Yeah, thanks. So thank you again for having me here, and I really appreciate the opportunity here. So just as a baseline, I wanted to start off with our 6-step financial slash retirement planning process. Although these can be applied to other goals as well, but as it pertains to the retirement planning process, we really want to just start off with, well, what are our goals? And we're going to go into some of those goals here momentarily, but what are the goals that we have? How much will we need for that? In other words, how much are we spending? How much do we want to spend each month? And then, of course, well, starting where we are today, by the time I retire, how much do I anticipate that I will have? And then is there a gap? If there is a gap, then we want to make sure that we start to address that. Again, I'll go into some more detail here shortly. And then, so in other words, what are some of the things we can or perhaps may want to do to address that if there is one? And then, of course, I would say as important and maybe even more importantly is how can we stay on track? How we want to make sure the beauty of the program is that everybody can continue to have access to a planner even after their separation, as long as they have at least $10,000 in their account. So I talk to a lot of people that not only just retired, but maybe have been retired for 5 or 10 years or maybe even beyond, to make sure that we are continually staying on top and on track of things. Okay, Frank, you can go to the next one. So the first one here is, what are our goals, right? So do we want to maybe work part-time in retirement? Are there some traveling that we want to do? Really start to get intentional and think about those things that we want to do. Where will we live? Do we have to buy? Are we moving to a different state? Are we moving to a different country? Are we moving to an apartment or a home? And then, of course, from a financial perspective, what are some of the things that we may have either thought about or maybe not have thought about? So if I'm looking at my monthly expenses and I'm running my retirement plan, did I actually factor in some of those potential healthcare costs, for example? So that's something that we will make sure that we model as well. And then for some people, there may be in the future or maybe even currently taking care of a parent or as they age, or maybe we still have children that we're helping them out with paying student loans, for example. So there could be always some cash crunches there, and so we want to make sure that we have those conversations. So when it comes to our retirement, where are we today? How many years do we have until retirement? Are we already retired? But also, how long do we anticipate? This is always, I usually get a chuckle with this one when we talk about, okay, well, we're going to run your plan till X. And I'll usually start with a number, and sometimes people will say, oh, I don't know about that, Dave. I don't think I'm going to live till 95, but you just never know. So we want to make sure that we run a plan that is representative of some of our expectations. There are some calculators available online. Live to100.com, for example, is one of them. So that way we can have, does it make sense for us to run a plan to 85, 90, maybe 95? It depends. Okay, Frank. So how much will we need? We want, this is crucial. I cannot stress this enough. This is oftentimes a conversation that I'll start off with even before we start looking at some of the other areas. What's coming in, what's going out each month, and this might change in retirement. For example, in the graph or in the picture here, you'll see that, well, once we retire, I don't have to pay FICA or SECA taxes anymore. And a lot of clergy that I talk to are very happy to not have to worry about SECA taxes anymore. But also, we may not be saving into our plan each year. So, what we usually start with as a default is that maybe our expenses are about 20% less in retirement, but I never want to assume that. That's usually a general starting place. We may want to assume that we continue spending the way we've become accustomed to throughout our time, but knowing what those numbers are is crucially important. Okay, Frank. So, what will we have? There may not be just one source, there may be multiple sources. We may have some personal resources, savings or investments in other plans, an inheritance, for example, our Wespath retirement benefits, the whole host of the benefits that you may have through Wespath, as well as Social Security. And we're going to talk a little bit more about some of that in detail. But these are, I would say, for maybe not everybody, but for most people, this might be the three main sources that you have for income purposes. Okay, Frank? And so, as I mentioned before, is there a gap? How do we even know if there's a gap? Well, you want to make sure you talk with your EY planner to say, okay, here's where I am, here's how much I'm saving, here's how much I'm spending. I want to plan to retire at 62 or 65. In other words, what's that price tag, and am I on track to get there? And so, when we walk through the retirement modeling tools, we can find out if we are on track, or if we have some time here, what are some opportunities that we can look at to make sure that we can help to reduce that gap if it exists. And so the sooner we know, then the better off and the easier our planning conversations will be. Okay. So what can we do? As a little teaser here, right? We can maybe save more, we can maybe work longer. Although I always want to make sure that we look at a whole host of different options as well. Could we potentially use an alternate asset allocation? I'd never want to say to somebody, well, we're maybe a little bit off, so let's get more aggressive. I don't think that that's appropriate in most instances, but it's always good to just review, is there a potential strategy that may help us to close that gap? And then, of course, reconsidering your goals and income needs. I want to spend X, but maybe I need to shave a few $100s off a month. Can I do that? Or on the contrary, some people might be able to spend more in retirement. That's always a possibility as well. Okay. And then, of course, in the same lines, when we talk about reviewing a potential asset allocation alternative, we'll want to make sure that we go through our asset allocation tool with you just to make sure, are we in a model that is appropriate for us? Okay. And then how can we stay on track? So we want to monitor and update that plan at least annually. In fact, for those who are getting ready to retire or those who are maybe already in retirement, there's a lot of participants that I talk to maybe 3, 4, 6 times a year, perhaps. But we want to make sure that we are continually monitoring that at least once per year. And so you want to make sure you schedule regular follow-ups with your EY planner. Now, Cheryl had mentioned at the beginning, there is a Know Your Numbers worksheet. So for anyone who's interested, feel free to reach out. But we would just wanted to see if there's maybe 2 or 3 actions that we can take a look at here today, and perhaps maybe even commit to. So complete the Know Your Numbers worksheet, which really takes you line by line through all of the typical household expenses. You don't have to necessarily complete that worksheet. You can also touch base with your EY planner, and we can go through a budget right through EY Navigate as well. Considering all of your financial planning needs, make sure that we're understanding what our retirement goals are. Again, back to what I mentioned before, do we want to travel? Do we want to, this is where these are fun conversations in my opinion, because this is where we can really start to dream a little bit more. Do we want to do an improvement to the home? Do we want to do some travel, so on and so forth? These are oftentimes very exciting conversations, and that also helps us to estimate our retirement income needs. For anyone that's joining here today, if you have not gone to Social Security website, which is ssa.gov, Social Security Administration, I encourage everybody to go on there today and actually create an account on socialsecurity.gov. So that way you have starting to build an awareness of what that income stream may look for you at 62, 67, and even 70, which can then bring up some conversations with your EY planner as to whether if you decide to utilize life stage retirement income, do I bridge Social Security? But it's good to know those numbers in advance. Go ahead and visit the EY Navigate website. So that's going to be wespath.eynavigate.com, and that's where you can actually touch base with your planner right on the website, or you can give us a call. And thank you for putting that number up, 800-360-2539. All right.
All right.
And I think we're going to pass it back over.
Yeah, we actually have to be
but would be
sensitive
more
to
than
time. This
happy-
has been a great conversation, but we are bumping up to it because we were thinking of raising up a whole series of questions as just a result of David's primer there, but we will have to move along. I will tell you, and speaking for the benefit educators here, that we are huge advocates for EY. We are always speaking about taking advantage of EY financial planning services. And one of the arenas that we do it in is when we have these virtual one-on-one benefit education consultations. This is a program that was kind of in the lab prior to the pandemic. Pandemic hit, we have been doing them ever since. It is a very successful program. The four of us love to do it. That's Todd Creviston there on your screen. You have a registration link that is right there. It'll also be in your follow-up email. You register for a 1.5-hour MS Teams video conference with one of us benefit educators. It's not a one-and-done type of thing. We'll get started. We'll look at your benefit access record, clergy service record, or your employment service record, run benefit projections, look at life stage investment management, anything that we want to talk about and discuss. You're not one and done. If you don't get through everything, we will just go ahead and schedule another. But what we have found over the course of these last several years is as our participants are going to engage with EY, they're getting ready to have those conversations, they'll oftentimes have a consultation with us so they can really get a good understanding of their particular situation, plans, accounts, account balances, benefit options, and then begin that conversation with EY. So this is really tangible proof that the partnership between the organization really is working and working well. And we encourage everyone to take advantage of the resources provided. And with that, there are some additional resources that Cheryl is going to walk us through and then take us home, as they say.
All right. So thank you, Frank. So we alluded to benefits access earlier. You can actually get to benefit access through wespath.org. Up in the upper right-hand corner is a benefit access link that you can go to, or you can actually go to benefitaccess.org. Lots of information that's available there. You can see all of your account information. This is where you can actually find your quarterly statements. They are not mailed out. They are actually there on the system, so you can see it. You'll get an email when it's ready, and you can go out there to Benefit Access and look at it yourself. Benefit projection tool. So again, if you want to maybe retire within the next year, 5 years, 10 years, that information is going to be out there, so you can do that modeling as far as and see how much you could be getting in retirement. All that investment information, all the different funds that are out there, lots of different resources, but something that we all stress during our consultations is beneficiary designations. Make sure those are updated. We know sometimes kids, grandkids, whatever, they like to move, change their phone numbers, so make sure that that information is updated in our system. All right, so once you've registered, you'll be able to go in and be able to see all that information on benefits access. Again, those quarterly statements, you can view those account balances, verify those transaction details. Now, you might see transactions happening out there, but you're like, I didn't do that. That could be the life stage. Thank you. I got kind of caught up there. Life stage with the rebalancing of the account. So that's where some of those transactions may be. And you actually see your investment performance going on as well. A lot of these participant resources, feel free if you want to take a picture of this, but again, this will be included in your email that is out there with the deck. All the different resources we have, customer solutions, benefit access, as well as EY. I think we've given you a lot of information regarding EY as to be able to participate with them, because they're there to help you plan your retirement that's going to be best for you and your family. action planning steps. It wouldn't be one of our webinars without action planning. So if you haven't already, enroll in UMPIP. Hopefully we've given you enough information to state all the advantages of being in it. Again, you have lots of different choices, how to contribute, how much to contribute, and that investment strategy, moderate, conservative, aggressive. Once you've registered, then you'll be able to actually register for benefit access. And then you can contact us for the benefit education consultations. We can help you with those questions before you hit, contact EY Financial Planning Services. Again, we're all here to help you have that salary in retirement and make sure it's the best for you and your family. So on behalf of Frank and David and I, we want to thank you very much for joining us on this webinar today, Q4 UMPIP. And thank you again for your time. Have a wonderful day.
Thank you, David.
Thank you so much.